All right, we have more changes unfolding in the U.S. economy and in the retirement accounts of hardworking Americans. Changes that have a major financial planning company, Fidelity Investments, coming out to warn their clients. And what was the warning? Stop pilfering your retirement accounts. Wait until you see just how bad this is, how much of a corner the Fed's now gotten themselves into. Just like what UBS said in their note that we showed last video, how once the numbers that the Fed has make their way to the public data set, it's going to be clear to everyone that the soft landing narrative couldn't be further from the truth. But before we get started, press the like button and consider subscribing. It helps me out, helps out the channel, and I appreciate your support. So the hard landing, folks, something that we were hearing in financial media day in and day out as ridiculous, not in the cards, and how the Fed has everything under control, how they're in the process of implementing this soft landing or even a no landing scenario, meaning that they're accomplishing their goal of returning us to 2% inflation without any major slowdown in the economy. Well, it turns out that's most definitely not the case. If you didn't watch our last video, we looked at a note released by giant European investment bank UBS, who warned their clients last week how the U.S. Federal Reserve is aware of this, how they have numbers that paint a very ugly picture going into next year and will be forced to cut rates by 275 basis points next year. In fact, look at where they forecast the overnight rate's going to be by year end of 2024. 1.25%, 1.25 freaking percent, folks. We're at 5.5% right now. So is that true? I don't know. I mean, this is what UBS says. They pointed to information that they apparently have that makes them believe once these numbers begin coming out, the hard landing is going to be clear to everyone. Well, take a look at this. The Fed minutes released yesterday concur with this sentiment. And just to be clear, these minutes are from the last FOMC meeting that took place 3 weeks ago, because the minutes, they always put them out 3 weeks after each meeting. Now, since that time, a lot's changed, right? Stocks, bonds, even Bitcoin all rallied. Even gold had a marginal boost higher. Now, we've also seen rate cut expectations spike with now 100 basis points of cuts priced in for next year, and term premium, the most important metric of all, especially if you're trading in bonds, crashed, falling back into negative territory. And likewise, the yield curve has reinverted bigly, like you see on this chart. But most important of all, tighter financial conditions, something that we talk about frequently on this channel, something that we've showed has been working in our favor, has completely puttered out. Prior to the last meeting, the market was working as it should, right? Tightening financial conditions on its own. Each time positive econ data was released, we'd see financial conditions rise. Well, that's gone, folks, out the window. Look at this chart. Look how much looser financial conditions have become since November 1st, completely crashing. And what happened on November 1st? The last FOMC meeting. Also, by the way, if you want access to our research database, the link's in the description. So the minutes, what exactly was said behind closed doors at that meeting? Well, let's take a look. First and foremost, all voting members agreed to hold the night rate at 5.5%, which is surprising. By this time, you'd expect to see some of the dovish members start to break off. And second, a majority of participants judged that one more increase in the Fed funds rate would likely be appropriate. Now, since that meeting, post-meeting, a lot has changed. Betting odds of one more rate hike are now at 0%. The market's now priced in 100 basis points of rate cuts next year, all because of last week's CPI print, which is ridiculous. Like we said last video, that CPI print was a joke, all drummed up by leaks to the media to boost last week's rally. In fact, here's Cleveland Fed President Mester being asked about this. Take a listen to this.
Let's go back just a couple days to the CPI data. How did you react to that?
Well, it was another good data print. I mean, I was pleased with how it came in. It's, continuing sort of the view that we're making progress on inflation, discernible progress. We need to see more of that continuing to be able to assess, that whether inflation is still going to progress as we hope it will. But it was a positive report.
Was it an all-clear report? Did it tell you that inflation has been vanquished and it's all
No,
going to be okay?
I wouldn't interpret it that way at all. I think we're going to have to see much more evidence that inflation is on that timely path back to 2%. But, we do have really good evidence that it has made progress, and now it's just, is it continuing?
So you didn't take it that way. Did you watch how the market took it? Did you notice that the idea of any future rate hikes was priced out of at least the futures market, and that all of a sudden they brought ahead the probability of rate cuts into the spring?
Well, the market's going to react to data. They're reading the data prints the way we are. But of course, I think our job is really to take the panoply of data out there. We're not going to react to one data release. We're going to look at all the data that's come in. And given where inflation was, we're going to need to be really convinced that inflation is on that timely path back to 2%. And I certainly would need to see more of continued progress the way we've seen.
Now back to the minutes. I'm going to read 3 statements that they made during that meeting, all right? The last one is the worst, bar none, has to do with the consumer and ties directly to this new data that Fidelity Investments just released. Something, by the way, that the Fed is fully aware of. All right, now this is about the consumer, or the fading consumer. Take a listen to this. Participants remarked that the finances of households, especially those in the low and moderate income categories, were increasingly coming under pressure amid high prices for food and other essentials, as well as tight credit conditions. And participants added that delinquencies on auto loans and credit cards had risen for these households. And realize, we've been hearing how the consumer's strong, right? They're so strong, and they've yet to be affected by the Fed's tightening. Well, listen to this. Participants commented that their district contacts reported a weaker picture of consumer demand than indicated by the incoming aggregate data or by the public data set. Well, we may have gotten some insight into this missing data or this mysterious data. Fidelity Investments, a company who has a huge client base helping wealthy families invest their money and plan for their retirements, but not only wealthy families and big businesses, they also work with people across the financial spectrum. And they just released a report, the contents of which is stunning all on its own and speaks to the health or the wealth of the consumer. How so far, listen to this, in 2023, and even more so in recent months, they've seen a massive spike in 401K hardship withdrawals, which means tapping your retirement savings. Now, before we look at this, I personally don't have a 401K, but I've offered them to employees in the past. And from my understanding, people only pull money as a last resort. A hardship withdrawal is done when you're in a bind, if you need money and you need it now. So let me ask you a question. If the economy is so strong, like what everyone says, how many people do you think would be in that position right now? Well, according to Fidelity, they're seeing 3x the number of hardship withdrawals, 3 times the number of people pulled money from their 401ks in 2023 thus far than they have had than they did for all of 2018. They used 2018, by the way, as a comparison because the pandemic years just skewed the numbers. And it's so bad, in fact, Fidelity started like an active outreach campaign to try and educate people on the risks involved with doing this. This is the report that they put together. It's available on their website right now. The title of it's Helping Employees Save for Emergencies. Don't let unexpected expenses derail your employees' financial goals. They write this: the percentage of plan participants taking an early withdrawal from a retirement plan has increased over the past 5 years. While 2020 was a unique year as participants saw penalty-free distributions allowed under the CARES Act, since then, though, in-service distributions, plan loans, and hardship withdrawals are all on the rise. In fact, more than 3 times as many participants took a hardship withdrawal in 2023 as they did in 2018. So why do this? Why would someone risk their retirement savings, incur penalties and additional taxes unless they had no other choice? Maybe because your credit cards are already maxed out or you're unable to get a traditional loan. Why would that be? Because banks are tightening their lending standards, making it more difficult to qualify, which we know is happening. We've been talking about that for the last year, something that we just read, in fact, in the Fed minutes a few minutes ago. Also, put yourself in the shoes of someone like thinking about doing this, right? The first thing you do is try and use your credit cards, but we know credit card debt has been tapped out. Highest credit card debt on record right now, not to mention credit card utilization is at record highs, up to 28%. So look, it's happening, folks. The data is lining up. It's already been affecting businesses. Now it's reached the consumer, and the Fed knows it. One more thing that they say in these FOMC minutes that you should know: they wrote this: Fed staff continue to see notable risks to the stability of the financial system. noting that valuations in equities, housing, and CRE, commercial real estate, are high. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.